Hey everyone, welcome to Talk Tickers. Today we're jumping right into Mohawk Industries' latest earnings call for Q2 2025.
All right, so here's the big question right off the bat. We got a beat for Q2, which is great, but then a pretty weak guide for Q3. And yet, the stock jumped. So what gives? What did the market see that made them so bullish?
And I mean, it wasn't a small move. The stock popped over 4% right after the call, on some pretty heavy volume too. This is a classic case where you just can't look at the headlines. You got to dig deeper. So let's do that. Let's figure out what investors were really looking at.
Okay, so let's start by decoding the actual Q2 numbers. We've got the beat, the squeeze, and the cash. And this is where the story starts to get pretty interesting.
Now, if you just look at the surface, everything looks pretty good, right? A clean beat, adjusted earnings per share hit 277, which was way ahead of the 262 the street was looking for. And revenue, well, it came in at about $2.8 billion, just squeaking by the estimates. So yeah, on paper, a solid quarter.
But this is where you see the real split, the story behind the numbers. The bulls, well, they're looking at the $126 million in free cash flow and, more importantly, a brand new $500 million share buyback. I mean, that's a huge vote of confidence from management. But the bears? They're pointing to shrinking margins and the fact that input costs are going to peak next quarter. Plus, that Q3 guidance was definitely a bit of a downer.
And yeah, you can really see that margin pressure right here. Look at that drop. Operating margin fell from 9.2% a year ago all the way down to 8%. That's 120 basis points. Management was pretty clear about it. It's a combo of higher costs for materials and just lower volume.
So, how is the company fighting back? This brings us to their whole repair strategy. They aren't just sitting around waiting for things to get better. They have a very specific playbook they're running.
You know, the whole thesis for this stock right now boils down to this idea: repair to re-rate. Think of it like this. Phase 1, the repair phase, is where they are now, fixing the fundamentals, controlling costs, being smart with cash. The goal is to get the company in fighting shape so that when the market finally turns, you get Phase 2, the re-rate, where Wall Street starts giving the stock a higher multiple. It's all about setting the stage.
And they're pulling three main levers to make this happen. First, they're in the middle of a big restructuring that's supposed to save about $100 million. Second, they're leaning hard on their local production. Get this, something like 85% of what they sell in North America is made in North America. That's a huge shield against tariff craziness. And third, of course, is deploying that capital. You know, that big buyback we just talked about?
And the CEO, Jeff Lauren, is basically saying, look, we know things are tough right now, but we're making these moves to get us through the cyclical downturn. The thinking is that these down cycles don't last forever, and when the recovery comes, they'll be perfectly positioned to capture that pent-up demand.
Okay, so the repair plan is in motion. But what's it going to take to get to the re-rate? What are the specific catalysts we should all be watching for?
Think of this as your investor checklist. First up, Q3. They lowered the bar. Now can they clear it? That's table stakes. Then you've got the buyback. How fast are they actually buying back shares? We need to see some signs of life in the housing market, obviously, and we need to see proof that the restructuring savings are real and are actually showing up in the profits. But really, the big one, the one everyone's watching, is inflation. If those input costs finally start to roll over after Q3, that could be the big trigger for margins to turn around.
All right, that brings us to our final section, the next call. Let's put this all together and figure out what might happen next.
So here's the thing. The stock has had a great month. It's up almost 14%, which leads to the million-dollar question. Is all the good news, all that repair stuff, already baked into the price?
Okay, so here's our take. For Q3, we think they'll land right inside their own guidance, somewhere between $2.56 and $2.66. But given how much the stock has already run, we think it probably chops around for a bit. So we're slapping a market perform rating on it. It just feels like investors are going to say, show me the proof, show me the margin improvement before they're willing to bid this stock up any higher. The real potential for upside? That feels more like a Q4 story, assuming those costs start to cooperate.
So, to sum it all up, the repair phase, that's priced in. The market gets it, they like the buyback, they like the cost cuts. But the re-rate, that's going to require proof. And that's the bottom line.
And as always, just a quick reminder, this is not financial advice.